Welcome back. Well, talk of tax policy has dominated 2017, but with the appointment of a new Fed chairman, talk of rewriting Dodd-Frank and the Volcker Rule, could monetary policy as well as tax policy become the real catalyst in 2018? We're back right now with the chairman of UBS, Axel Weber. You know, you mentioned energy earlier, Axel. I want to drill down on that a minute because this president has made that a focus, a priority. Is that an infrastructure play? I mean, because when you look at the energy space, we can drill and be an incredible producer. We already are on the global market. That's going to be a job creator.
And it has been, and you know, as we're seeing infrastructure investment, you know, start taking hold, and as we're starting to see energy investment come up and normalize, that's going to be a contributor to growth. The bigger issue, and that was discussed, you know, in Paris, is what does energy consumption and non-renewable energies do medium to long term to climate? And so, whilst in the short term there's clearly a stimulus, there are some risks in the long term from basically exploiting all the biological sources of energy. But as an economic stimulus, it will take hold. And you must see the key issue of what caused weakness 2 or 3 years ago was actually the massive drop in oil prices and in oil production. So it's not as if we're pumping this up. It's normalizing. Yeah. And what we're talking about is really a world economy that is coming out of a crisis that is normalizing. And even if the Fed, as we said before, goes to 2.5%, 2.75%, that's an average normal interest rate. It's neutral. It isn't actually restrictive. The Fed will not go as far as restrictive. And if you look at what drives growth in the U.S., usually when we teach students about growth, we tell them, look, it's people and unemployment is at an all-time low. It's capital. The U.S. is one of the deepest capital markets. It's energy. There's just been a rebound in energy. And it's technology. Talking about Silicon Valley and all the new IT revolution, all the artificial intelligence. So I think the economy on the major things that matter for production is actually doing very, very well.
Well, money is mobile, and money is going to go where it's treated best, which is why this tax plan is so important. You are the chairman of the largest wealth management company in the world. You are the former president of the Bundesbank. You've seen a lot in business in terms of behavior. Will companies behave differently with a 20% corporate rate versus 35?
Oh, absolutely. And, one thing that was always discussed was under the heading of base erosion and profit shifting, that basically companies in various countries saw and produced an erosion of the tax base of that country by moving profits around the world and moving profits to where taxes were low. And the U.S. was, with 35%, among the high tax havens. Now, with 20% coming up, most likely, that's going to change. It's going to be as low as in your most competitive European economies. And so corporates will be quite keen to show profits at headquarters rather than at some subsidiary where they are working and producing. So you're going to get global corporates look at investments in the U.S. because of the favorable treatment of the first 5 years of these investments. And I think this investment boom is going to be a contributor to growth in addition to the relatively good consumer confidence. If you look back a year ago, there was quite a difference between sentiment indicators, which were at all-time high, and the actual readings of the economy, which were much softer. And there's always two ways how that goes away. One is sentiment has been too high and it comes down where growth actually is. This time around, it was the opposite. Sentiment remained high and positive, but actually growth accelerated, and now that gap is disappearing. Output gaps are closing, unemployment is at record low, inflation is coming up to normal. And so what we are looking forward, and that lifts the mood, is we're no longer in a crisis environment, we're coming to a normal environment. Yeah. And that is lifting the mood.
And the earnings are showing it, by the way. You had a great couple of quarters of earnings just in the last few quarters. So what do you do then as an investor at this point? You've got clients all over the world. You've got a big business in Asia and throughout the emerging markets. What do you tell clients about the market here? Are you saying that given that growth is about to pick up, the stock market follows suit, even though we've already seen $5.5 trillion in market value gains since the election?
Yeah, we're still overweight equity, and we've told investors that they should keep being invested rather than cashing out. If the tax reform comes, this will provide a major stimulus for corporate America, and corporate America is going to invest, and that will drive market valuations possibly another 10% higher over the next 1 to 2 years. So this is an environment where you should not check out. And also at the same time, being long equity, we're also long the U.S. We look at the U.S. as a favorable investment environment. And actually, when you look at the rest of the world, we're more bullish on Asia Pacific as a region that has grown pretty massively. And part of our business, a big part of our business, is in that region. That region is very entrepreneurial. And the largest number of new billionaires generated is actually in Asia Pacific.
That's incredible.
So Europe and America is old money, so to say, because people have been rich and driving industry for many, many years. So the developed world is a rich world. But the new emerging markets in Asia Pacific are really catching up, and they're becoming wealthy, and they're very dynamic. So for us as a global bank, it's important to have 20,000 people in the US, but it's also important to have, a very strong presence in Asia Pacific, because that's where a lot of the wealth generation at the moment happens.
Yeah, I think this is such an important point that you're making, and I wonder if that's where you're going to see higher growth numbers, even more so than the U.S.